Welcome to today's event, The Impact of the Fed on the Corporate Bond ETF Market, hosted by CFA Society Chicago's Education Seminars Advisory Group. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you would like to ask a question, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Rich Excel, CFA, an instructor of finance at the University of Illinois Geese College of Business, as well as a senior portfolio manager at Wolverine Asset Management in Chicago. Joining Rich for today's discussion are Jeff Kanages, senior portfolio manager for Invesco's exchange traded funds, and Bradley Kotler, vice president of SPDR Sales Execution and Implementation Group at State Street Global Advisors. I will now turn it over to Rich.
Thank you, Nicole. Appreciate that. Welcome, Brad and Jeff. Thank you both for being here today, and welcome to all the attendees. Thanks for joining us for what I think is going to be a very timely discussion around what are very volatile markets right now. So before we dig into the nuts and bolts of the Fed action in the corporate bond ETF market and the need for that action, maybe we should start by kind of going through the mechanics of the ETF market. I think many of our members might be fully aware of kind of the plumbing of the ETF market, but many may also just kind of trade them the same way you trade stocks. So Brad, can you walk us through like the creation redemption process for an ETF and how important that is certainly in the less liquid ETFs?
Sure, and it's a great question. Thank you. So first, what I want to do is discuss liquidity and the origin and genesis of liquidity for ETFs. So there are essentially two layers of ETF liquidity. First one is the secondary market, which is liquidity that is available at the exchange, where buyers and sellers meet to exchange shares at very tight spreads. Oftentimes, much of the ownership transfer does not result in bond trades. So if I look at one of our high yield products, in the month of March, this product saw a primary to secondary ratio of 6-to-1, which means for every 6 shares of an ETF traded, only 1 share resulted in a bond trade. And so this is because the other 5 shares are just an exchange transfer where there's a buyer and a seller that agree upon price. The other source of liquidity is the primary market. And this primary market essentially kicks in when demand is larger than the supply at the exchange at any given moment. And so authorized participants, who are often the liquidity providers, are able to sell shares to a client, and they are able to then collapse that short, or essentially cover the short that they sold to the client, by sourcing a basket of bonds that are eligible for the index and the fund, making sure that those bonds meet the criteria for the index methodology. Those bonds also have to have all the sector weightings, the proper duration, the ratings metrics that are appropriate for the index and the proper weights. And once the basket is negotiated and agreed upon, the AP delivers the bonds into the fund and receives shares back, and essentially now their position has been covered. So the creation redemption window and mechanism is essentially just exchanging eligible bonds in basket form in exchange for shares.
Okay, awesome. That's a really thorough way to get us kind of going today. Jeff, kind of following on from that process, from your seat as a portfolio manager, what are the criteria or factors that you would use to determine whether a bond issue is eligible for any of the ETFs you manage? Is it purely formulaic? Is there some discretion involved, or how does that work?
Sure. Well, I guess, yeah, as Brad kind of outlined already, almost all bond ETFs are index-based. So our goal as portfolio managers is to ensure that the bonds are either currently in or will be included in the future index for that particular fund when we're investing in these bonds. So none of our corporate bond ETFs are exact replicas of their indexes. They're all what we call representative samples. And like Brad said, we use factors like duration, sector, issuer, and credit quality to kind of match the index factors most closely. So there's really an element of kind of semi-active portfolio management in our passive ETFs, especially in, extremely small funds or ones that track indexes with thousands of index bonds, or funds where the components are not very liquid.
Okay. So even before we kind of got to the point of the pandemic and what's taken over from now and the financial market crisis, I think there was some talk or some concern in the market that certainly in the bond ETF markets that the ETFs could have an impact on the daily liquidity, even though the ETFs, I think at AUM, are only about 4% of the corporate bond market on a daily traded basis. They're much larger. Brad, can you maybe speak to how important this issue was, and for you or your clients, and was it overblown? Was it overblown in the media and the stories that we saw, or did you ever feel that this was a potential issue with the markets?
Sure, great question, and we do hear this concern often, and the headline is, ETFs are distorting their underlying asset classes. So I think when we hear that, it's important to take a step back and get some perspective using numbers. So, and I'll use high yield ETFs as an example, because that's usually the sector or the asset class within fixed income that we hear this about. So the high yield cash market in the US today is $1.32 trillion, and the high yield ETF market is about $64 billion. So that's about 4.9% of the AUM in high yield sit in ETFs. So that's of course a very small number. More importantly, or equally as importantly, is these bonds that are eligible and that sit in these funds are the most eligible and liquid part of the high yield universe. So the index methodology for the indices and for the ETFs are things like amount outstanding minimums, right? Many high yield ETFs won't allow more than 400 million won't allow sizes lower than 400 million or 500 million outstanding. Sometimes they have age restrictions, right? The bond has to be issued in the last 5 years. And there's those types of things. So what the indices and the methodologies are good at are isolating the most liquid parts of the market. So the fact that it's below 5% of the amount outstanding, and it's also the most liquid part of the market, certainly gives me, and I think investors, a lot of comfort that high yield ETFs aren't going to distort or have impact on the underlying cash markets.
Okay. And there's also some concerns, I think, of the kind of the large swath of investment grade credits that sat just above junk, and the impact that could happen if there were downgrades there. Jeff, kind of how has that played out, through this whole pandemic and financial crisis?
Well, bonds that were issued with investment grade ratings but have been downgraded to high yield status are known as fallen angels. So fallen angel bond ETFs actually fit the Fed's criteria for their ETF purchase program. And the largest one is the 1.9 billion ANGL, which I think is an awesome ticker. The ICE Fallen Angels Index that this ETF tracks had in March 214 issues with about 115 billion market value, while in May there are now 307 issues with about 194 billion in market value. So the number of fallen angels has increased substantially, but it's still a fraction of the US corporate bond market. It's only around 2.5% of the corporate sector. So this particular ICE Fallen Angels Index is up 10% since the end of March on a total return basis, while the investment grade ICE Corporate Bond Index is up 6.3, and the high yield index is up 7.7. So despite the recent downgrades, Fallen Angels bonds have continued to outpace other corporate bonds during the past 2 months, but if you kind of data mine it a little bit, it's all a matter of timing. On a year-to-date basis, the Fallen Angels Index is down 5.3%. High yield is down 6.4%, but investment grade corporates are up 2%. This makes sense because once Fallen Angel bonds get dropped to junk status, they're no longer linked to treasuries, and treasuries have been the top performing bond sector this year.
Okay. So why don't we kind of jump into the topic du jour, the topic of the event today. And Brad, what was happening in the ETF market in March that caused the Fed to kind of feel the need to enter the market? Or was it simply a problem in the cash market where the Fed's kind of felt that maybe via ETFs is the best way to help this out?
Right, and so I think you did a good job in the second part of your question, alluding to what was going on. So essentially concerns of the economic shutdown and really uncertainty around the reopening of the economy. I mean, many of us don't know if we're going to be going back to the office, and particularly in March, we had no idea if we were going to be going back in June or if we were going to be going back in 2021. So this was a big macro driver of large outflows, and these, this wasn't only in fixed income ETFs, this was in broader fixed income, this was in equities, this was in commodities, really indiscriminate selling in everything that one could sell with very little regard for price. Liquidity was really the only priority for what was being sold. And so, the important thing was ETFs were essentially, what happens in ETFs is that they are a window into what's going on in perhaps less transparent asset classes like fixed income. So we saw in ETFs, as a result of what was going in bonds, very large discounts in particularly the corporate IG products, the high yield products as well. And this is because there was no real ability to sell the bonds, and the ETFs are just a reflection of what's going on in the underlying market, as I mentioned before. Essentially what happened with the Fed was they wanted to add stimulus to the market, right? They want to create liquidity, and they want to be able to support individual corporations. And they're first of all very aware of how important ETFs are to the fixed income market ecosystem, right? So aside from your traditional buy-side investors who are looking to gain exposure to an asset class, lots of individuals in the market who are participating there to provide liquidity use ETFs as a tool to hedge, to source bond liquidity, to turn bonds into ETFs and ETFs into bonds. And so the ETFs are essentially a liquidity valve for the overall fixed income market. Number two, it was essentially the quickest way for the Fed to add stimulus to the market. So we're all aware of the SMCCF and their aspirations to buy bonds in the future. And I don't believe that they've done so. I can't confirm that, but I don't believe they've bought in bonds yet. And I think part of that is because they're going through such a complex process of figuring out who are the issuers that are domiciled in the US, and what's the universe of bonds that we can buy, and what issuers need help that haven't taken money from the CARES Act. And so there's this complex process of figuring out what bonds are eligible that doesn't have to take place for ETFs. So ETFs were the first place where they access the market. And, I can speak a bit about the Fed program, but that was, in my mind, those are the two reasons why they chose ETFs, because they wanted to access the market and add liquidity quickly. And they just know that ETFs go hand in hand with the fixed income market from a liquidity perspective.
And just for the audience, can you clarify what the SMCCF stands for?
Yeah, the Secondary Market Corporate Credit Facility.
Okay, awesome. Thank you.
Quick.
Had that on the tip of his tongue.
Yeah.
Jeff, what's your assessment of how corporate bond, how fixed income ETFs performed in March and April, relative to, as Brad's kind of said, certainly they're a reflection of the underlying markets, but relative to what the mandates that they have relative to those markets, how do they perform?
Yeah, well, I guess I'd like to focus on March, which is certainly an outlier month, I guess, where nearly all markets kind of were living in dog years, given the massive swings in volatility and lack of liquidity, even in treasuries and money markets. So I guess, 6 of the 10 worst days ever recorded in investment-grade corporate bond history occurred in March, including the 5% drop on March 18th, which was the worst one-day sell-off ever. So, kind of more on the PM side, from a flows perspective, there was a record $255 billion in bond mutual fund redemptions and around $20 billion in bond ETF outflows. But what's more interesting to me is the fact that U.S. listed bond ETFs traded a total of around $740 billion on exchanges in March. And that means only around 2.3% of the total bond ETF assets were redeemed from these products, while over 720 billion worth of bond ETFs traded in the secondary market without any forced selling in bonds. And that really benefited bond ETF investors because that small percent of liquidations helped these funds avoid significant transaction costs, especially in sectors like corporate bonds where the bid-ask spreads were at historic wides. So I think the strong secondary market liquidity in times of extreme stress like we saw in March indicates to me that bond ETFs performed exactly as they were meant to.
And I think maybe perhaps you could talk about it a little bit. Is the U.S. really predominantly the largest market for ETFs? I mean, there's not too many ETFs, my knowledge, in Europe or Asia. So in times of crisis like we saw, do global investors come to the U.S. market, U.S. ETF market, to source liquidity to hedge?
Yeah, it's definitely the largest. Second largest would be Europe. It's a much smaller market. They're probably 5 to 7 years behind us in terms of kind of AUM growth, but and then Asia would be a distant third. So there are some even European domiciled UCITS ETFs that will contain U.S. corporate credits as well. So there's probably some billion-plus funds in UCITS format that are primarily meant for European investors that were could also be, I guess, influenced by the Fed bond buying program, and I guess but again, it would be on a much smaller scale than what we've seen from the U.S. ETF market.
Okay. Just a reminder to everyone, if you want to use the Q&A button at the in the middle bottom of your screen, I think it is for most people, that's how we'll be taking questions from the audience today. So if you want to use that, and you can queue up those questions for us. Brad, Jeff was just kind of laying out how well relative to how expectations ETFs did perform in March, especially April, March, and April. What types of questions were your clients asking you at the same time when they're picking up the phone and calling you? What were the concerns, or what was the opportunity?
Sure. So I think the biggest one is why are fixed income ETFs trading at such large discounts? We did a decent amount of work on attribution for those discounts and what drives those. We came up with 4 real reasons, or 4 real drivers of the discounts we saw. Those include stale or unexecutable NAV prices, a mismatch from a market structure perspective in NAV strike times to ETF closing times. One's at 3 p.m. typically, at least for a majority of ETFs. The other is at 4 p.m. That's the equity close. We did see some suboptimal trading behavior in ETFs. I always say there's a right way and a wrong way to trade every ETF. They're very liquid instruments, but if a client has to sell $200 million worth of high yield exposure in the last 5 minutes of the market, well, I venture to say in the ETF they can, but they should expect that there's going to have some impact to that selling. And then, typically the last one is going to be just your overall liquidity premium, where dealers who were absorbing the risk that clients were selling to them, as I mentioned earlier, didn't know when they were going to be able to recycle that risk. So they had to build in a liquidity premium to cushion that. So that was the first question. And the second one was, how do you recommend trading fixed income ETFs in this environment? So, and a lot of that came at the tail end after the announcement of the program, where clients realized the benefit of having ETFs as a liquidity sleeve in their fixed income portfolios. So they typically allocate 5 or 10% of the portfolio to a like exposure in ETF for moments just like we saw in March, where they have to raise cash, and it's very hard to do so in bonds, and so they sell an ETF to raise that cash. And so what they wanted to do when the market calmed down a little bit toward the end of March was to add that position back, but in a larger allocation. And so the question was, I want to have a larger sleeve of ETFs in my portfolio. How do I trade it? And so we talk about things like certain order types, right? Avoid your market order types. Trade when the underlying market is most liquid. So if you're going to be trading a European Govy ETF, don't trade that in the afternoon in the US because the underlying market's closed. Trade when the creation redemption window is open for that particular ETF. And then, if you have larger size to trade, work with one of the many liquidity providers on a consultative approach toward being able to add or reduce risk in larger positions. So it was the discounts and it was how to trade in those stress times.
So one of the things we've seen impact other markets, particularly equities, is the systematic strategies. And you talked a little bit about the timing, trading more towards the close, et cetera. We see the same thing in the ETF market, in the corporate bond ETF market, where systematic strategies are having a greater and greater impact on the volume that's being traded.
Yeah, I would say so. I think the ETFs are great because they afford exposures that in the fixed income asset classes that can be traded as, I'll say, freely or as liquidly as an equity. And so oftentimes they choose the ETF as the vehicle for exposure because bonds are not an easy asset class to trade, especially a diversified approach. In such a method of ease of trade. So ETFs, we certainly do see that. It's just important that, as I mentioned earlier in my example, you're not putting a lot of volume through the market. These unsocial sizes that are they can be traded, but you're going to have impact. And why not be a little bit smarter about when you trade and how you trade to minimize any market impact that you have?
Okay. Getting a little bit more specifically what the Fed's doing, and even though I know the program was announced in April, began in
Sure.
early May, hasn't really, I don't know to what extent we have much data on what's been going on, but can either of you, Brad, maybe focus with you, give us a better idea of what specifically the Fed is doing, what instruments are they buying,
Sure.
are there limits in how much they'll buy on a daily basis, et cetera?
Right. So from a reporting perspective, they haven't given much. So a lot of this is my own interpretation. But just from a timeline perspective, they announced the program, the PMCCF and the SMCCF on March 23rd to support credit and liquidity in the market. ETFs were added March 29th to that mandate. And then, the SMCCF is going to be funded with $25 billion, which can be levered up 10 times, so $250 billion in secondary market buying of corporate bonds and corporate bond ETFs. The focus is going to be on investment grade as the primary exposure, and the secondary will be high yield. So we do expect that there will be more investment grade exposures bought than high yield. And one of the big rules of thumb is that the Fed will not be larger than a 20% holder of any of the individual ETFs. And we interpret this as a rolling number. And so if they max that number out today, and I'm not saying they will, that would be somewhere just shy of $40 billion in ETF purchases. Again, the program began May 12th. It ends September 30th, so that's 98 days of trading. And they've put some constraints around prices they're willing to pay, which actually, some of which changed in last night's update on their FAQ on their website. So they restrict themselves to not paying more than the lower of 1% over last night's NAV, or 1%, or the average premium discount plus the standard deviation of that premium and discount over a 52-week period over NAV. So a little complex, but essentially they have an awareness toward buying into premiums. They have not given us a list of tickers. There are about 105 corporate bond ETFs. It's about 60 IG products and 45 high yield products. And just observing the market so far, volumes have been pretty light. So they announced on their website, on their weekly update last Thursday, that they held $1.801 billion so far. And all they did was give essentially one line item on the consolidated balance sheet that said, net portfolio holdings of the corporate credit facility 1.801 billion over the first 6 days. So doing the math, they're buying about 300 million a day, and that's the average. Again, we don't know tickers. One thing I'll say is they're doing a really good job in staying under the radar in their security selection and their execution, which I have to imagine, I don't know for sure, is deliberate. And I think that's a feather in the cap of the ETF market, right? They're 9 or 10% of the market volumes every day on average. They announce that they're buying to the world, but nobody knows what they're buying and how they're buying it. So it speaks to the flexibility, the anonymity, and the liquidity of fixed income ETFs. And I believe going forward, they've had the pace of 300 million a day so far, which is certainly less if you extrapolate that over 98 days than the $40 billion. But the markets have been pretty orderly. So if volatility comes back and stress comes back to the markets, we anticipate that they'll probably pick up the pace in their buying. We don't know that for sure, but that would be our guess.
And this is just a question for both of you, maybe Jeff. It's purely an opinion from you guys. Any thoughts why they're using the ETF market instead of just going directly into the cash market and directly to the issuers?
Well, I guess.
Sorry, Jeff, go ahead.
Sure. I guess, I think it's the idea that, the Fed, through purchasing a single ETF security, can gain access to hundreds or even thousands of individual line items of bonds in that ETF, each ETF portfolio. The other idea there is that, the Fed, by purchasing individual ETFs as opposed to individual credits, they could avoid, any regulatory or, scrutiny from people looking at, they're not diversifying their portfolio. So I think it gives them a very broad-based exposure to the market and in the corporate side of things. And I think that's really what they've done here by utilizing ETFs within their entire bond buying program.
Brad, you want to add to that?
Sure. I think, as I mentioned, ETFs and their index methodology typically point toward the most liquid parts of the market, which is essentially oftentimes what the investment banks hold for inventory. So if the goal is to turn that inventory over, and to do so in broad strokes, meaning in a diversified approach, using an ETF where creation redemptions are going to happen across multiple line items, trading the ETF rather than the bonds would be, number one, a quicker way to do it, but also would have that kind of diversified approach toward providing balance sheet turnover for the banks.
Okay. It sounds like this is not an issue. This next question isn't an issue just yet because they're doing a pretty good job of staying below the radar, but maybe if volatility picks up and the Fed starts to step up the size of their purchases, Jeff, how might a portfolio manager process like potentially large inflows or outflows that are being impacted because of Fed actions?
Sure. Well, I guess I haven't made any shameless Invesco ETF endorsements to this point, but I guess I can do that now. I can pick one of our bond ETFs as an example. So from our perspective, our largest corporate bond ETF that would qualify for the Fed purchases is our BulletShares targeted maturity investment grade fund that matures at the end of 2021. And this fund is about 1.9 billion in assets. So the Fed could purchase a total of around 400 million because the Fed, as Brad mentioned, is limited to 20% max ownership. But, since the Fed is not an ETF authorized participant, what they would do is they would contact us through an ETF market maker. And the ETF market makers who are facilitating any of these large sales in the secondary market might end up wanting to create new fund shares on behalf of the Fed's purchases. So in this example, the BSCL portfolio managers would then decide whether to take cash and invest that amount themselves, or they could just allow the ETF market maker to deliver bonds in an exact subset of the fund, which is called a pro rata basket. Now, most ETFs can also allow the ETF market makers to deliver in specific bonds in or out of the fund that will help them better align the fund to its particular index. And in any ETF flow scenario, the goal of the portfolio manager is obviously to track the weights of the index's bond portfolio as closely as possible, while at the same time minimizing transaction costs. And again, as Brad said, the Fed has started out slow in their bond purchases. Again, this single fund could take up to 400 million in a day. So if they're spreading this out over time, I can't see it as impacting the portfolio management of any of these funds in a negative way.
Brad, you mentioned this a little bit earlier when you talked about in March, where we saw the discounts to NAV and some of the corporate bond fixed income ETFs. What's been the impact we've seen on the discounts or maybe premiums since the Fed's kind of come into the market?
Certainly a reversion.
But feel free to use shameless plugs for State Street ETFs as well if you want.
Sure. We did see a reversion back as the Fed announced they'd be buying ETFs. In typical "don't fight the Fed" style, investors went to where they believed there would be demand for product. So there has certainly been a reversion back. Initially, those products did trade with premiums. Those have come back. So fixed income ETFs right now are back in line with expected premiums that they would have. And typically, you would always expect, or I should say, usually in steady markets, expect a slight premium. At least in our products are marked to the bid side for NAV. So you expect a slight premium for where the ETF to trade and to close. So that's part of it. And typically the size of the premium has a lot to do with both the bid ask of the underlying asset class, supply and demand in the market, and the ease of creation and redemption by authorized participants facing off with the portfolio manager. There's been certainly a reversion back as clients move back into the ETF space, and the market feels a lot more normal than it did in those second 2 weeks in March.
Mm-hmm. And has the liquidity noticeably improved in the market?
Absolutely. So, if I look at the investment grade ETF market, we have 4 investment grade ETF products. Bid ask in those products has collapsed since the month of March by 43% in investment grade and by 30% in high yield. Volumes have dropped, and so a lot of people will scratch their head and say, why is volumes dropped imply better liquidity? Volumes have dropped relative to the cash market. So in times of stress, we often see, and there's a lot of data that suggests this. In times of stress, we see a freezing, or at least a big spike in illiquidity in underlying cash markets. And because investors, realize how difficult it is to trade in some of the parts of the fixed income market, particularly corporates, they tend to flock to the easiest asset class to trade that has the best liquidity, which would be ETFs. And so we typically see a spike in ETF volumes relative to their underlying cash markets. And so that absolutely happened in March, and it has since reverted back where ETF volumes relative to the cash markets are back where they were pre-crisis. So volumes are back in line with the cash market. Premiums and discounts have moved closer to NAV. We also are seeing large block trades take place in the market, and they're happening with less impact to the market as well. So those block trades are happening close to the price of the exchange, the NBBO, and close to NAV.
Okay, Jeff, what changed for better or for worse? I mean, have you seen in the ETF market since the start of the year? I mean, obviously a lot's clearly happened this year. What changes in dynamics have you seen throughout the year?
Well, I guess, one thing that I really think that a kind of a positive outcome of this whole current crisis is that, ETFs have historically been a mainly retail investment product, but the Fed's decision to include bond ETFs in their purchase programs might have been a real blessing. I think it goes a long way to validating bond ETFs for institutional use. It seems like the Fed decided that they can achieve some of their goals, stabilize the overall bond market by investing a portion of those funds in bond ETFs. So if you think about it, I mentioned earlier about they can own a single ETF security and can gain a lot of broad-based exposure. So I think that's been a big positive that we've seen. And as Brad mentioned, the kind of rebound in normalcy occurred in the bond ETF market in the same time as it occurred for the overall bond market. So I think bond ETFs and the bond market have gone hand in hand, and I think again the ETFs have kind of proven their worth to be more of a real-time indicator of where these markets should be valued on a daily basis.
Is there any discussion from the Fed on what the exit strategy is or needs to be?
I have not, seen anything in regards to kind of the ending of this program in September. I mean, I guess, as Brad mentioned earlier, if we do come upon another situation where we've got another big displacement in the markets, then, the Fed could step in more aggressively with their bond and bond ETF purchases. But, again, based on the details in the Fed communications about their purchase programs, it's apparent that their end goal is really not to drive prices higher. It's really to kind of psychologically support the market. So until there's that need for more bond market stabilization, I think it's going to be kind of steady as she goes in terms of the bond purchase program. As Brad mentioned, only 1.8 billion in total bond ETF purchases so far. I think they're close to 700 billion in terms of agency mortgage-backed security purchases already. So it's certainly not much in terms of bond ETF buying, but just in kind of stating the words alone that we're going to include bond ETFs in the purchase program. I think that's certainly really been psychologically supportive for the markets.
Okay. I'm going to turn to some questions from the audience now. And just a reminder to use the Q&A tab or the Q&A button at the bottom of the screen to ask some questions. Brad, this one's, I think, for you. We probably touched on it a little bit earlier, but the question is, over the last month or two, we've seen a handful of trades fail to deliver, specifically in the iShares iBond series of ETFs. Have authorized participants taken longer periods of time to create shares? Is this naked shorts, or is there something else going on?
It's a good question. I don't think I'm going to have a great answer on it. Those aren't our products. One thing I can say is I don't think APs are taking a longer time to source underlying bond baskets and create ETFs. We do observe pricing, volumes, premiums, and discounts in the market to ascertain if there's buying trends or selling trends in the market. And we typically find that there's matchup between outsized flows in either direction and a commensurate creation or redemption. So I think, I think that has, I don't necessarily think there's an issue now with turning over those positions. And it typically is in market makers and liquidity providers' best interest to cover their shorts and longs by redeeming or creating, because there, of course, are costs to the balance sheet to do so. I'm not too familiar with the fail to deliver in those iBond products mentioned in the question.
Mm-hmm.
But given record issuance that's happened in the market over the past 2 months, right? We're already, I think 75% through what we saw last year from an issuance perspective. I think there's ample liquidity to create and redeem the products from an underlying bond perspective. So I'm not aware of any issues from a liquidity perspective or a bond availability perspective.
Okay. Jeff, any thoughts on that?
No, I pretty much agree with Brad. I mean, from our seat on the PM side, I mean, there are cases when sometimes there are failures even in normal markets. We have cash in lieu held in the funds that are priced, so the value of those bonds, the missing bonds is actually still available. So a portfolio manager could, go at some point in extreme cases and, look to buy in the market maker. And if they can't deliver the bonds, we could always take cash and substitution as well. But again, those are more extreme cases. And I think at least what we've seen in our fixed income lineup so far since the beginning of this coronavirus crisis has been pretty similar to what we see in normal markets.
Okay.
And if I could add one more thing,
Sure. Absolutely.
there is market structure in place to handle when there's failed to delivers and things like that, or broken trades and those types of things. The market certainly has a lot of protective layers from broken trades and insolvent authorized participants. Our capital markets teams monitor the solvency of all the authorized participants very regularly, just to make sure that anybody who looks to deliver bonds and receive shares from us, or perhaps they're posting collateral and those types of things. So everything's very sturdy and kind of comfortable from an oversight perspective.
Okay. Here's another one, and I'll read it out. And it says, as I understand it, money managers are advising the Fed. BlackRock is involved with the credit program. PIMCO is involved in the commercial paper liquidity facility. Any thoughts about large market participants assisting the Fed? I appreciate you won't want to speak about your competitors, but in general, I guess this is more of a conflicts of interest type of question, or maybe it's angle is does this why the Fed's not having much of an impact because they are getting some input from the street. So I guess it could go in any direction there. Any thoughts on that?
I mean, in terms of the Fed bond ETF purchase program, BlackRock was designated as the kind of sponsor for this particular program, and they're obviously around 45% of the U.S. fixed income ETF market. So they have a huge presence, they're the biggest player, and so they were obviously given kind of the ability to manage this process. And as Brad said, it's gone very smoothly so far. I guess the way they manage this for the Fed has been very quiet, and I guess we are obviously collecting fees just like the other ETF providers are for any sales to the Fed, but BlackRock is not collecting any fees. They actually have waived fees for the Fed, so I think they're going to be a less biased party, and the Fed probably kind of put them up to that directive that we're helping you by making you represent us in this program, but beyond that, I think they're going to be an unbiased helper to the Fed, who is looking to really kind of diversify, probably not just across different types of bond ETF strategies, but across issuers as well.
Brad, you want to add to that?
Yeah, the one thing, and I totally agree with Jeff, the one thing I'd add is it's stated in the investment management agreement between the Fed and BlackRock that, two things. Number one, there's a very distinct wall that cannot be crossed as far as information sharing goes. Conversations with BlackRock's FMA, they're the counterparty handling the transactions, and the rest of the company. And then the second one is BlackRock is not allowed through the purchase of their own ETFs to increase their own market share more than they had prior to the program, I believe. So if Jeff said they were 48% to start, they have to finish at 48% or lower compared to everybody else. So that certainly keeps or quells any concerns about them overbuying their own products. Okay.
It's really good to know. Here's another question that comes out. Can you talk a little bit about the ETF financing markets, the stock, kind of the stock loan and borrow? Is there been any impact? I wouldn't assume the Fed's going to loan out its holdings for shorts, but anything we've seen, any impact in the market? Any thoughts on that?
The one thing I can say is it's in the IMA also that the Fed will not be lending out the ETFs that they buy in this program, so no SEC lending. And just on an overall basis, I mean, there's a very large SEC lending program that happens in all ETFs. You see ETFs like SPY, our S&P product, very large SEC lending program. And that's the case as well in fixed income ETFs. So anybody who wants to express a short interest or wants to short stock for investment grade high yield treasuries, munis, mortgages, etc., they can do so by borrowing shares. So there is availability, and we do see in times of stress an uptick in creations that others would be scratching their heads saying, well, if everything's for sale today and high yield is, down 2%, why were there creates last night in the ETF? Oftentimes what that is a very large demand for borrow for the ETF for short sale. So market makers and investment banks will go out and create shares, hedge the exposure, and then lend those shares in the market to satisfy the demand that's out there. So in some of the most liquid ETFs, if you see counterintuitive flows in stress markets, oftentimes it is the securities lending market looking to satisfy the demand in that market for short interest.
Okay, so maybe more important to pay attention to the NAV premium discount and not so much the flows in one direction or the other.
Yeah, I would agree that the two combined are certainly a good approach, but seeing an outflow in a high yield ETF when the market's on fire, or seeing an inflow when the market's selling off, I would turn to premium discount, just like you said, Rich. That's a good place for things to make a bit more sense.
Okay. Jeff, we'll punt this one to you. Any thoughts on why high yield corporate bonds and bank loan ETFs traded more orderly and had much smaller discounts to NAV than some of the safer haven fixed income ETFs like short duration IG/floaters?
Definitely a tough question. I mean, it's a bit of a mystery why, kind of AA rated commercial paper was trading in a liquidity vortex in mid to late March. Municipal bonds were at huge discounts as well. But I think in terms of kind of that high yield market, I think it certainly wasn't necessarily more orderly. And I think that what we've seen play out in the markets overall in terms of kind of not flows, but performance, it's definitely played out that the higher credit quality, it's been performing much better. So that flight to quality dynamic has definitely, occurred through this point in 2020. So you got your treasuries at the highest end and your kind of emerging market and high yield and then bank loan at the bottom. And I can't put a real good idea on it other than that, as Brad knows, when he used to sit in the ETF market making seat, when you're trading these lower credit quality, more risky sectors of the bond markets, you are more careful when you are enacting inflows and outflows into the funds, and just because there could potentially be more volatility. So that it might have actually worked in the favor of, bank loans and high yield bonds, that they weren't pressured quite as hard, just given that they might be tougher to get back later on. And I think that's probably, what we've seen is that these markets have recovered a majority of their losses, especially in treasuries and IG, but high yield just hasn't quite rebounded as significantly. So they didn't sell off as significantly, but again, they're still definitely lower in terms of performance this year.
So maybe a function of selling what you can and not what you have type of thing?
Yes, exactly.
Brad, any thoughts on that?
Yeah, I mean, I agree with a lot of what Jeff said, and what I'll add is that, the high yield market, a market where, the underlying credits have some stress to them from a corporate health perspective. The high yield market certainly is more used to volatility than the investment grade market, which, a lot of investors consider to be really stable credits and those types of things. So the investment grade market had never really seen volatility like that. And so I think, it shocked a little bit more. I think the other thing is the investment grade market is much larger, right? So, and that's in ETFs as well as underlying bonds. So, and I'll say in ETFs, it's probably double. So in the spirit of investors just looking to raise cash and selling everything that they can to do so, there was more volume there was more holdings and volume to be sold in the investment grade market. And that was something that the market perhaps had never seen before. So it could have been just historically high yield being a more volatile market and the participants being used to handling that. It could have been the larger market in investment grade. And when all that came for sale, but there was more impact as far as, measured by discounts.
Okay.
Yeah. Also, the high yield market is much more of a manual kind of voice traded market, whereas investment grade is kind of more towards the electronic platforms. But in March, that all kind of fell apart. So, it might have also been, to the advantage of high yield traders to be able to call everybody up like they normally do and enact some big trades. And in the IG side of things, when that kind of electronic system broke down in mid-March, I think there's probably a lot more, shock to that market and maybe a little bit more confusion that may have pressured investment grade side a little bit more.
Yeah, that's a great point, Jeff.
Okay, another question here. What are your views on factor-based ETFs and ETFs that apply rules-based screens to their starting benchmarks? Question for either of you.
Well, I guess I could take that since we had a lineup of factor-based ETFs, and we currently still have two. And what's interesting is that, I guess, just kind of pulling up their performance here, but I can tell you that in terms of the kind of two that we have, there's an investment grade defensive and investment grade value fund. So if you look to the beginning of the year, the investment grade value funds only up around 1.1% year to date. Defensive is up 4%. And then if I look at our more broad-based, fundamentally weighted investment grade ETF, that's up about 2.5%. So the defensive factor definitely did its job in terms of kind of market outperformance in the markets we've seen so far this year.
Okay. Last question. I'll pose the last question. Oh, actually, there's another question from the audience, but I'll go to that one. What changes could you suggest for pricing providers, ETF issuers, to put into place to get over the lagging and stale NAV issues seen in those that hold OTC securities? Brad, you want to take that one?
Yeah, sure. I think perhaps this was the impetus that the corporate bond market needed to really reconsider the way that the market trades, right? There's no exchange, there's no market hours, there's no central limit order book in corporates. And so perhaps this is what, and I know there's a lot of projects out there to kind of push this narrative. I think perhaps there needs to be some mandatory quotes from dealers. There needs to be perhaps better methodology in screening trace prints. I think there are, these electronic bond trading platforms that have tons and tons of data, right? Because they're seeing not only where bonds trade, but where interest, where cover prices are from dealers, number of dealers that respond to a bond price. Perhaps their data needs to be brought into the fold of pricing bonds, because what happened in March, and I don't think since then, in the last 2 months, much has changed. There were certainly, in my opinion, a shortfall in the bond pricing. Just for some data, I was looking at 2 investment grade ETFs that held almost 500 of the same bonds. And so when I looked at the identical bonds in 2 different funds, priced by 2 different agencies, in one of the most volatile days in March, I saw that the average difference in price between these 2 bonds was 83 basis points. And that's both 3 p.m. bid side mark. And I even saw some bonds that were 16.6 points apart. The same bond, again, being marked 16% different. So, I think it's really important to reconsider where bond pricing comes from. We did see a lot of the naysayers of ETFs, I'll say, point at the ETF and say the ETF's broken, the ETF's broken. They're all trading at discounts. And I think if you look at a discount, you have 2 parts. You have the closing price for the equity, or the ETF at 4 o'clock. You have the ETF struck at 3 o'clock. Most want to point toward the close. I point toward NAV as being the issue, right? And that's not an ETF problem, right? Difficulty in pricing bonds. That's a problem that the bond market has just generally accepted and moved on with, right? So you see stale and inexecutable NAV prices for ETFs, mutual funds, SMAs, and all types of fixed income vehicles. So it's not an ETF issue, and it's generally accepted, and it just exacerbated in the stressed market. So I'm glad you asked the question. It certainly is an issue that I think needs to be addressed, just because of some of the optics that we saw in March.
Mm-hmm. Jeff, any other thoughts?
No, not really. I mean, because of the over-the-counter nature of bond markets, I mean, it really needs to have better central reporting for trades and prices. And I guess the SEC has already come out in the past couple weeks and said they're kind of looking into fund pricing, where some of these markets where there's less liquidity, was there prices being overridden by the fund providers. I think that's something that's always a difficulty in the minds of kind of the fund providers themselves. Do we use our price, or which we know is where we've traded this particular bond in the afternoon on any given day, or do we take a price that's a point or more away just because it's what our pricing service says that's where this bond should be valued? So I think it's still something that's got to be sorted out, and I think there will be more of that to come from SEC guidelines in the future in terms of bond pricing.
Okay. One last question for both of you. I know it's early days in the program. We've talked about the Fed has had no huge impact yet, but we've also had back-to-back, I think, top 5 months in terms of new issuance in the credit markets. And any thoughts on, this Fed backstop, implied or real, how is that impacting the markets in terms of pricing versus expectations? Is their impact going to be seen more so in the secondary market? Have they had the impact they hoped without having to do much?
Yes. Yeah, I agree that's the case. U.S. corporate bond issuance has been occurring at a record pace on the investment grade side, near record pace on the high yield side. And the market seems to be absorbing this new supply extremely well. There's almost a vibe like the Fed has your back, and that's kind of played out from what we've seen. The spreads on even the new issues have certainly continued to compress, and so it's telling us that the market has absorbed this supply very well.
Brad, any last thoughts?
No, I mean, I think Jeff did a great job in answering the question.
Well, I think you both did a great job in answering all the questions today. So thank you both, Jeff and Brad, for joining us today, and as well as thanking everyone who attended this event. Anyone, if you have any questions about today's event, please contact the CFA Society of Chicago. The email is info@cfachicago.org. So thank you to everyone who attended. Thank you again, Brad and Jeff, and stay safe, stay healthy.
Thank you.
Thank you.